Welcome today. We are having a very interesting panel today on the future of trading. Welcome to all of you. I wanted to introduce very briefly our panelists for this discussion. It's a discussion that will focus largely on two issues relating to the future of trading. Issues in the derivative space with the inevitable move from swaps to futures-based trading and the kinds of new products and institutional microstructural changes that we are seeing with regards to how products are devised and packaged. But we're also going to look to the equity space today. We're in a new world, obviously, where tweets can drive the momentum of trading with regards to markets, where high-speed traders are having an enormous impact with regards to the liquidity on public exchanges, as well as driving how transactions are being facilitated in dark pools of liquidity. For these and other interesting issues involving the international implications of these changes and, again, the transactions that are driving our financial markets. We have Bart Chilton, Commissioner from the Commodity Futures Trading Commission. We have Terry Duffy from the CME Group, Jamil Nazarali from Citadel Execution Services, and Lou Salkind, who's the Managing Director and Executive Committee member of the D.E. Shaw Group. My name is Chris Brummer. I'm a law professor over at Georgetown University, where I teach securities regulation, and I'm also a securities, the senior fellow at the Milken Institute, as well as on the National Adjudicatory Council of FINRA. With that out the way, Bart, we've seen a lot of changes over the last couple of years, particularly with regards to our derivatives markets. We're still very much in the implementation phase, but maybe you could just spell out for the audience briefly some of the key changes that you're seeing and what those changes that we've seen up to this time will likely mean for some of the market participants who are on stage.
Sure, Chris. Well, two things. One, I always like to say at first that these futures markets, as opposed to the swaps and futures markets, would then be, the derivatives markets. But the futures markets, the thing that Terry and his able crew deals with all the time, they weren't the cause of the financial meltdown, right? Nobody lost their shirts because of what they had in futures. So CME Group and the Intercontinental Exchange, those guys do a really good job. But that doesn't mean that we can just accept everything as it's all cool. And we've seen a lot of changes in markets recently, changes with technology, as Chris said, and also changes with regard to how people speculate in the market, which is different from how they began speculating when the Board of Trade began in 1848. And so those are things that we're looking at, particularly with regard to a group that I call massive passives. And there's nothing wrong with these guys. They're liquidity into the market. They're good folks. But these are people that took the strategy from the stock market, where you invest and you hold your investment, hold your position, and they've done that in futures, where they'll invest in crude oil or something, and they don't really care about the summer driving season or about what OPEC's doing. They're betting on a couple of years down the line. And that's just a different strategy that many reports show as having some impact on markets. And the second group are high-frequency traders, the guys that don't like when I call them cheetahs, as in the fastest land mammal. And those guys are out there 24/7, 365, trying to scoop up microdollars in milliseconds. And again, nothing wrong with technology. Happy with the cheetahs. They're good cats. But there are times when you wonder if they're having an impact on markets that is just something different than we've experienced. And the hack attack last week, the Twitter thing that was bogus about the White House, that's a really good example of how markets can act so quickly where they wouldn't have done that 10, 15 years ago. So both the massive passives and the cheetahs, and there's other things, Chris, but those are all areas that we need to look at as we're going forward. And I think regulators need to have a better view about maybe what's around the corner instead of what's hitting us in the face directly.
All right. One of the key changes that we're seeing from the regulatory end, again, has to do with moving some of these relatively unregulated products, such as swaps, either onto exchanges or imposing new kinds of regulatory capital requirements. And that's obviously changing the way, Terry, that you're doing business and many of your clients are doing business. Could you perhaps talk a little bit about that? Certainly we've seen with regards to the CME Group and with other exchanges moving energy swaps to futures exchanges. Is this the future of futures? Is this what we can expect to see with other kinds of derivative instruments like credit default swaps? What do you see in light of the new regulatory environment in which you're operating?
You know, even prior to the regulatory changes that we had with DoddFrank and other regulation, I was a big believer that we were going to get more business going.
Yeah, I think that your mic is your.
Okay. I was a big believer, Chris, that we were going to see more migration from unregulated bilateral products into the listed market only because they become more accepted. CME Group is in 150 countries around the world. They become more mainstream. They're transparent. I just think those are all pluses for it. I didn't think the government needed to get involved and tell people how they should do their business. I think they should have done it by incentives. So if you wanted to clear your business, there should have been an economic incentive to take that risk out of the bilateral transaction. There shouldn't have been a government mandate to do it. If you wanted to not clear that transaction, then you should pay a different capital charge for that because you're putting the system potentially at risk. You can't just assume that you're going to transfer all the risk to clearinghouses and all the risk goes away. I was very adamant in the Dodd-Frank legislation that I will not accept certain swaps, and that had to be written in the law because we don't even understand some of these swaps. How are we supposed to risk manage them? We can't blow up the whole enterprise because the government says you have to clear that swap. So I think there's a lot of differences in there in the marketplace. So I think we're seeing more and more migration coming to the marketplace. I think the last person that a hedge fund wants to face is a redemption of a client that says, I'm on a 2-and-20 deal and I've lost your money because of a bilateral risk. And in today's world, if you do that, especially where the markets have gone the last several years, someone's going to say, haven't you heard of a central counterparty clearing system? Haven't you heard of different safeguards in there? Your counterparty walked on you and that's why I lost money. That will be unacceptable in mainstream. I think just that fact alone will take products away from the bilateral transaction more into the clearinghouses because what does it do? It gives you a person to blame in case of a default. You can't, instead of blaming the broker, you'll blame the CCP.
And we'll get to Jamil in just a second, but just as a follow-up part, when you hear about the fact that now there is certainly some concern among market participants about what kinds of almost unforeseen risks could be associated or spillovers with regulatory requirements, where exactly is the regulatory environment heading with regards to clearinghouses at the moment?
Let me say, by the way, I agree with most of what Terry said. Not all.
I didn't agree with anything what you said.
I know. I was hoping when your mic came on, I was hoping you were saying you did agree with me. But here's the thing. We did need to include stuff in Dodd-Frank for these unregulated swaps. That's what caused the meltdown. I'll give you one reason. 417 billion buckaroos that we all paid in a bailout. Yeah, I think I want to see those as a regulator. And so we're doing that. Now, a lot of those are being moved to the exchanges, and that's the part where I do agree with you that it's great that there's added clearing. We call that the futurization, I guess, of swaps. So there are, if you ask me, what's the best thing that this Dodd-Frank law did, which is essentially the answer to your question, Chris. It requires capital and margin, greater capital and margin, so that we know that what Terry's talking about is less likely to happen, that there's money to actually back things up. So here's one just quick example. When Lehman Brothers went down in 2008, and they had all these credit default swaps, they were leveraged 30 to 1. I mean, nobody in their right mind would think that's cool, right? And we saw the result, and there was a reciprocal impact on the economy. So the one thing in Dodd-Frank, I'd say, greater capital and margin. We're working on that. We'll get finished. The second thing I'd say, by the way, is bringing these unregulated, over-the-counter, OTC swaps into the light of day. Some of that's happening through this futurization, but we as regulators, me included, we've really been irresponsible in not putting in place these things called swaps execution facilities. They're called SEFs, SEFs. And these are going to be sort of mini platforms where the swaps can be traded. And we have been stuck in a quagmire internally at my little agency trying to figure out the details. And it's driving me nuts that we don't have this done, because there are businesses out there, a lot of these platforms, just waiting to compete. And they want to compete with Terry and with Jeff Sprecher at ICE. And we haven't given them the simple rules of the road. And even if the rules of the road aren't the rules that I like, we should give them the rules of the road. Otherwise, by default, we are essentially creating winners, and Terry doesn't mind that part a little bit probably, winners and losers, and that's not right.
All right. Well, Jamil, I won't necessarily ask you to wade into the landmine should you so choose, but where we are seeing a lot of competition, particularly in the equity side, is with the proliferation of different venues for trading, whether or not it be on exchanges, but ECNs, dark pools, and the like. And this is changing the trading environment in ways that in some ways resemble what's happening in the derivatives market, and then in some ways are leading in the opposite direction. But I know that Citadel is a key liquidity provider, and you're relied on by lots of retail investors. What do you believe, or how do you view this proliferation of venues? What do you think that means with regards to some of the transparency issues that we're obviously hearing Bart talking about? And then secondly, what role does high-speed frequency trading play in this change in the microstructure of trading?
Well, those are two very good questions. Citadel has a very broad and somewhat unique perspective on the markets. On the one hand, we have a large hedge fund that's a large institutional investor. We also run one of the largest equity market making businesses. We have an automated trading business, which Bart calls Cheetah. We have a dark pool, and we're a strategic investor in a number of public exchanges. So we have a very broad interest in the stability and integrity of the markets. And from our perspective, we feel very strongly that over the last 10 years, the automation of the markets have resulted in much greater liquidity, transparency, and lower trading costs for everyday investors. High-frequency traders are often tagged as the boogeyman. And the reality is that in any financial market, intermediaries are needed to provide liquidity to ensure the functioning of those markets, whether you're talking futures, whether you're talking currencies, whether you're talking equity markets or treasuries. Those intermediaries are the lubrication that allows the system to function. And 10 years ago, that intermediary function was done by specialists and market makers, literally thousands of humans sitting on trading floors. Today, computers do that better, faster, cheaper, and the results have been unequivocally good for average individual investors. Having said that, that's not to say that the markets couldn't be better. So two things that we think are really important are, one, that as the markets evolve and become so technologically dependent and interconnected, it's important that we develop the risk protocols to manage and avoid one player having some kind of computer problem that brings down the whole system. And we believe very strongly in exchanges playing a vital role as a gatekeeper and having kill switches. Secondly, we are concerned with the increasing level of trading that is occurring off exchange. And right now in the US equity markets, 40% of all trading happens off exchange. Now, we're really happy with the competition that's provided for the exchanges. That's resulted in lower costs and greater innovation. Having said that, we are concerned because those off-exchange trading venues are controlled by broker-dealers that don't have the same requirements for fair and open access. And for some stocks, much more than 50% of the volume is trading in those off-exchange entities, and some traders are shut out of that. And so we're very concerned by fair and we're very concerned and think it's important to have the need for fair and open access.
Well, fair and open access, a huge issue that Jamil is bringing up. Lots of retail investors are concerned. They're concerned that either more likely than not, if they're on an exchange, they're dealing with a high-speed frequency trader, or if they're off an exchange, they're dealing in an environment where the rules somehow are working against them. They're concerned about folks not only working in milliseconds, but now picoseconds, which as a trained lawyer goes way beyond my mathematical ability to comprehend. Lou, what do you see about these developments when it comes particularly to the issues of fairness? You know, there have been lots of concerns not just about the speed issue in cheetahs, but really what that means with regards to possibilities of market manipulation, of a technologically sophisticated ability to effectively front run orders. How should the little guy feel about this, as well as obviously other institutional investors?
Yeah, well, I think we have to look at the data. And I think the data says pretty clearly that let's just compare just any measure of market quality from a decade ago. Bid-ask spreads are probably, a fifth of what they were. Commissions, I remember when commissions were 1% for equity trading, and now we're often counting commissions in sub-cents per share. So trading costs generally have been an order of magnitude less. Trading volumes are an order of magnitude more. And we see deeper markets. So the other thing is that not that people shouldn't be afraid of the unknown, but the fact is that their costs of trading are lower. And a lot of the so-called market manipulations, they happen before computers and before high-frequency trading. So I would say that when we look at the broad landscape, first, probably anyone in the finance industry, it's probably heresy to say this, but I think a lot of the regulatory changes have been good over the last decade. And that's not to say that they can't get better or that missteps weren't made. For example, during the financial crisis, we certainly think that the banning of short sales in market after market, every time that's happened, it's decreased liquidity, it's increased volatility. But by and large, the move to NMS, rule NMS, has encouraged competition. If you think back a decade ago, there was a duopoly in the equity markets. New York Stock Exchange and NASDAQ basically controlled all the volume, and essentially that was even a monopoly because they had different stocks that they traded. If you look today, no one exchange probably has more than 20+% of the order flow, and it's amazing that it used to be that liquidity attracted liquidity, and now we have much deeper liquidity and a pretty fragmented market, which encourages competition, allows us to execute better.
And Chris, I'd like to just touch on something that you said, which I think is actually really important. There's a misconception that retail investors are somehow disadvantaged by the technological changes and by the fact that some have, computers co-located in the various exchanges. And the reason is that firms like ours, Citadel's market making business, we execute trades for those retail investors. So we have co-located computers in every single one of the exchanges. We have connectivity to every single one of the 30 dark pools. And by trading through us, we level the playing field for retail investors. And they are able to, for their $10 a trade, have these millions of dollars in technological investments at their disposal. And so I think the trading, the playing field is very level. And as Lou points out, by almost any metric, if you look at how the average retail investor has fared, they are much better off than they were 10 years ago.
Bart, is everything fair?
Well, no. And first of all, let me say, if you want somebody to be skeptical, I think I'm the guy, right? You want the regulator to be skeptical. I don't have a profit motive in this. I work for taxpayers. That doesn't mean I'm right all the time. I agree. But I'm the guy you want asking questions. So most of the research does say what you guys say. Not all of it. In fact, the regulator did some. And we did some in January. And what it showed is that when a cheetah trader, now that's different than like Citadel. I'm talking about a cheetah trader who is, it's a cheetah program, but these are proprietary firms. They're just trading for their own book. They're not doing retail business. When those guys trade with other folks, they make more money when they trade with smaller retail guys. $3.49 on an average $50,000 trade. So, and then they make the second most from commercial guys, so these are people that have skin in the game, and then when they're trading with somebody like a Citadel, they don't do quite as well. So there is some evidence out there. The problem, Lou, I think, is that we don't have some of this looking deep. There's been lots of studies, and I don't disagree with the stuff that's out there, but we don't know everything. You know, there's that old phrase, you know, I don't know what I don't know. We don't know everything about how this gee-whiz bang technology is impacting markets. And I'm just saying, let's take a step back. The hack attack was a great sort of ping to say, maybe everything's not all okay. We don't require that these cheetah traders are even registered with us. Now, Terry's got their number, but we don't have their number. If I want to see their trades, their books and records, I'd have to get a subpoena from a judge. Meanwhile, they're headed to the shredder. So I want them registered. I want to make sure they test their programs. All the good guys test their programs. Terry ensures that they do the best they can. Of course you test it, but not all of them do. Maybe there's a bad actor that doesn't. So my thing is just, let's be a little skeptical. Let's try to ask the questions. If we get all the research that says there's not a problem, fine. But if you think about all the problems in markets with technology very recently, and going on, whether or not it was, you know, your former firm was Knight Capital, or whether or not it's, you know, Terry's group having some computer glitches, or any number of other ones. It's very rare they have problems. But lots of exchanges have problems. We all remember the IPO Facebook, NASDAQ that had a problem. So we shouldn't just swallow technology, say, all good, all good. Not necessarily so.
Terry?
Yeah, a couple things. As it relates to the AP Twitter hack the other day, think about what was hacked and what was said. It was said that the White House was attacked and the president was hurt, right? So think about that for starters. That is a pretty frightening tweet. The S&P 500 went down 18 index points. It did not go down more than 1.5 index points at any given time on a whole move. It was a 1% move. So think about that as far as what did the cheetahs really do, supposedly. They didn't do anything, right? If they did, it would have went down 2% with no trades in between. That was not the case. Second of all, when you look at the securities markets versus the futures markets, there's two very big differences. One is called fragmentation across the different pools of liquidities, whether they're dark pools or different exchanges, versus our world, which is a vertical silo. The high-frequency traders participate almost twofolds in the securities world as they do in my world. Why? Because it's broken. It's fragmented. And there's an inherent advantage to be able to buy a stock at one place and sell it at another at the same exact time at a different price. That doesn't happen at my place. At our institution, because of a vertical silo, high-frequency traders have built up such a huge pool of liquidity and has given farmers, ranchers, refiners, and everybody else to do all the risk transfer they need in the deepest pools of liquidity. But I'm also, what we're seeing at our place is we're seeing a big decrease in high-frequency trading. Why is that? Because there's no fragmentation, and the market has become so efficient that all you have these people doing is buying and selling from each other, and then they are not market takers, they're market makers, as you know. So then the market takers come in, do their risk transfer, and it's actually a great benefit for them. But their volume is decreasing. It's not decreasing in the securities world because it is a fragmented world. You can't have dark pools and like that. You can't have exchange traded and like that, and can't have all the things that you want in one shop and say that's all good, and one of it's not bad. But because the problem is, you talk about cost. We have 98% of the U.S. listed futures market at the CME Group. 98%. We've been around for 165 years. We have never charged a lower price in the history of our company than we do today. 98% of the market. You would think we could probably turn the knob a little bit, right? We don't do it. Why? Because we believe in the Walmart model. We're going to do more at a lesser price, and that's what we are doing today. Why? Because of the vertical silos.
will the Dodd-Frank Act and the recent rules continue to permit that level of integration, or will it push the industry in sort of unforeseen directions? So if you look at a CEF versus a data repository and the different kinds of rules, is this, there's always a tension in financial regulation. On the one hand, we want to have competition, but at the same time, we want to have an effective market and with a lot of market integrity. I'm very curious because, again, we've seen new product development, but from the way in which you run your business, are you seeing more possibilities for fragmentation and a change perhaps in that?
Here, I think what's important is when you go through these changes and when Bart and his colleagues finally write the rules for the CEFs, and we all know what they are, a CEF will be one to many. Whatever that means, it means one to many. I'm not quite sure what that means. It's not a central limit order book like we have. So when you have a default like Lehman, Bart brought up Lehman earlier. We liquidated Lehman's portfolio in 3 hours. The Lehman portfolio on the broker-dealer side, I don't even think it's liquidated yet. It's still a disaster. There's still lawsuits pending and everything else. We were able to liquidate that. Why? Because of the deep pools of liquidity that are involved in a vertical silo and the more participants trading in a product. When you have bilateral transactions that only Bart and I understand, well, nobody else in this room is going to participate in that trade. When I have a central standardized contract of Eurodollar, Standard & Poor's 500, NASDAQ, or whatever the case may be, there's a whole host of people who understand the characteristics of the standards of that contract. They will participate in default. That's why it is important to note the difference between futures and swaps. And when CEFs come out, they should have 5 days margin. Why? Because you have less participants able to participate in a default. That's the most important thing from a regulator's perspective and from a taxpayer's perspective. In my world, I have multiple people all over the world ready to participate in a single standardized product. That should be a 1 day margin, and that's what it is. And if you don't want to have any margin, it should be a 10-day cost.
Jamil, is there too much fragmentation on the securities end?
I don't think so. Well, let me take that back. As I said before, we feel pretty good about the increased competition that's resulted in the last few years. We are concerned with how much is trading off exchange and the fair access. But having said that, the equities markets work extraordinarily well, and some of that fragmentation results in additional competition, which drives innovation and keeps prices down. As Terry pointed out, there are some automated traders that are more active in the equities markets, and part of what they're doing is they're knitting together those various pools of liquidity. We do believe very, very strongly in the importance of liquidity, in the importance of having things done fully transparent on exchange. But given the market structure we're in, we are doing our best to make sure that ordinary individual investors get the lowest costs by knitting together that fragmentation.
Lou, I'll follow up with that question with the extra issue of the global dimension.
Well, I'd first say that the New York Stock Exchange probably did not want their market fragmented, and they didn't want that competition. But in the end, it did add to the value of liquidity and to the quality of markets. I'd like to just circle back on the DoddFrank and the swaps regulation. I mean, things that we think are very important there were, first, the move to central clearinghouse. We saw a landscape where certain counterparties were over-margined, other counterparties weren't margined at all. I think you never know for sure if these changes are going to reduce or add to systemic risk. But if we look over the years at how clearinghouses have handled extreme events and financial crisis, they tend to do a good job. And I think by balancing that out and bringing the buy side into the clearinghouse, I think that's a very positive change. I would say the other thing that we think is extremely positive in terms of swaps regulation is while they're teething in implementation problems right now, the promise of price discovery, which really does add to the quality of the markets, is embedded in DoddFrank, and that we will have electronic dissemination, hopefully in real time soon, of price and size. And that allows also, as we talk about the future looking forward, Just like in the equity markets, fragmentation is compensated for by doing cross-market arbitrage. We're going to see in the future with these types of changes, cross-asset class arbitrage increasing. What that does is it adds more pools of liquidity. It sends price discovery signals around much faster.
Right. Just also to follow up, international. I was going to get to you, obviously, with regards to your conversations with colleagues around the world, because many of these issues are not just local issues, they're international issues. How Germany decides, for example, to deal with high-speed frequency trading, or Canada, could very well impact our own markets. Yeah. How exactly we decide to regulate our clearing houses, and whether or not there's a registration requirement in Europe is going to affect what we do here. And I will follow back, but I guess the most appropriate place to start is with you, Bart, and both as a reflections on what our
Well, I would say the harmonization of regulations across the globe is going to be a big challenge for regulators looking forward. But I would say that internationally, they were, the electronic genie is out of the bottle with the cost of, communication dropping, computer cycles dropping. Essentially, foreign markets leapfrogged the U.S. markets for a while, but I think the U.S. markets have roared back. But looking at internationally, they've experimented with electronic trading in different models for a decade or more.
What are you seeing around the world?
Let me give you just one quick thing, and not to keep focusing on my furry friends, the cheetahs, but again, I'm not opposed to these
Really,
guys.
I'm not a cheetah.
I know, but with regard to the genie's out of the bottle and technology. And maybe these guys are just the new floor traders, just the guys that are in those great pits. And maybe they're the grease that lubricates the whole thing. If that's the case, that's the case. I'm just saying, be careful. And we talk about, well, they always add deep liquidity and everything. I mean, the old speculators, when the Board of Trade started, man, they might hold a position for months and months. These guys are in and out, so it's fleeting. They don't really take on much risk. Now, it's liquidity, so I don't disagree it's liquidity, but it's fleeting liquidity, and it's just a different type of liquidity.
It's voluntary.
So you're right with a lot of automated traders. I would say that there are many true market makers. Citadel is a true market maker. I can assure you we take a lot of risk. I mean, we manage it well, but we take on positions for longer than a few minutes.
And I'm really talking about the proprietary cheetahs, who they don't want to hold risk overnight. They're not about holding something for 3 months. They're about in and out.
They don't hold.
They don't. And you don't charge a margin. That's part of their deal. They don't want to have to be charged anything, right? They just want to get out. So these are risk transfer markets, and if they're not taking any risk, or if they're taking it for a nanosecond, is it cool? And maybe it is. I'm just raising the question. And the last thing about the volume is that, there are times when their computer programs bump into each other. And again, I'm talking about primarily the proprietary ones. And that's not right. And it looks like there's volume. But they're just, and it lowers bid and ask spreads because I'm bidding and asking the same thing. And I'm remember Billy Idol, Dancing with Myself? They got nothing to lose and nothing to prove because they're dancing with themselves. And this is occurring at a voluminous level, is all I'll say. And so it's just something we need to look at further. To get back to your question on the international thing. So, we're looked at as the bad guys because we're sort of first out of the box on DoddFrank. And, first movers in everything usually get a lot of hits, and we're getting a lot of hits. You've done this wrong, you've done that wrong. And they're right a lot of times. We've done some things wrong. That's how you learn, right? So the question is, how do we harmonize these rules and regulations so that it doesn't create regulatory arbitrage? So they don't say, oh, the rule book is too thick in the US, we're not going to trade with Terry, we're going to go to ICE in London or someplace. Because we don't want that. So it's a balancing act for us. But the answer for a lot of folks in the financial sector has been, well, just don't do it. Or just put in this provision that gets me out of it. Or write this little thing, and then that'll make it not effectual. So, as a regulator, your job is, well, what's real? What do we have to do? How do we separate the legitimate concerns of business from the overall concerns, sort of what you teed up to begin with, the need for transparency in markets. And that's what we're doing. I think we are going ahead of the EU, but they'll come on board. And we've had lots of great conversations. And in my view, globally, last sentence is that it's sort of like that, Field of Dreams. Remember Kevin Costner? If you build it, they'll come. If the U.S. and the EU do fairly harmonized rules and regulations, I think the rest of the world will come. And there won't be some market migration to whatever country has the thinnest of rule books.
Can I just comment here? Because I first of all, I agree with what Bart just said. I think that's very correct.
Right, they're called Ripley's. Let's.
But I think what's important to differentiate here is when you talk about fragmentation in the equities world and you talk about costs associated for the client, first of all, the client, for the most part, pays nothing. In the securities world, there's mostly a payment for order flow, which in my mind is already an inherent conflict of interest when someone's willing to pay for your flow, right? So that's right away, you got to think to yourself, what's that all about? Second of all, when we had the flash crash, a lot of people wanted to focus on a firm out of Kansas City and focus on the futures markets because they thought that led to the flash crash, right? So when I testified in front of Congress, I had a bunch of these fancy slides to show congressmen exactly what happened. And what happened was when the S&P 500 futures went down to a certain level, we stopped when kicked in what's called stop logic functionality, okay? So but everybody wants to blame the CME and a big asset manager out of Kansas City for the flash crash. But the problem is Accenture went to zero or a penny. How do you explain that after we were already going back up? Because of stub quoting, because of all other inherent conflicts of interest involved in the securities world, and because of the fragmentation. Because when an order went to the New York Stock Exchange to sell Accenture, it said closed, no shopping. Let's go over to NASDAQ, closed, no shopping. We'll go to the dark pools over to, not the Citadel, but somebody else, and they said, we'll stub quoted at a penny. So they traded Accenture at a penny. So the guys at Accenture going, wait a minute, my stock's at a penny? I mean, that's obviously ridiculous, and the trades were busted.
But the
in my world,
the happy ending is that we had circuit breakers, limit up, limit down.
But the point is, we already had that in place in our world. I offered up that technology free to the rest of the securities exchanges that didn't have it, and they still don't have it in the back rooms of dark pools.
So, but kudos to you guys for having that, and kudos to the regulators for having circuit breakers and now limit up, limit down, and those will be enforced across dark pools. There's not going to be any trading in dark pools if the lit markets are in limit up or limit down. So you're right, that was a problem with the markets, and to Bart's point earlier, the markets are not perfect and we need to be constantly skeptical and looking at how we improve on them. That, in our view, is a great improvement and something that will prevent the flash crash from happening.
I think the regulators have to look at these things, but other participants, from investors to exchanges, they also have to sort of stew on these changes as well. And I just think the New World Order, clearly we've gone more electronic. I think when we started 25 years ago, people questioned whether you could ever profitably trade using a computer model. Right. I mean, that was considered, like, we were told again and again it could not be done. And now it's hard to imagine people trading without algorithms, from hedge funds such as ourselves to the largest institutional investors.
I think the most important thing, whatever world you're in, is to make sure that the participants have confidence in that marketplace. So from a regulator standpoint, to an exchange standpoint, to a DE Shaw client or a Citadel client, if they don't have confidence in that as a legitimate marketplace, they will not participate. So that is a big part of what I'm doing right now, is making sure that they have the confidence in the marketplace, showing them on our website what we do to capture the cheetahs from front-running somebody, what we do on how much we spend. We're a public company. We spend $40 million a year in surveillance. We have a tenth of our workforce dedicated to make sure certain our markets are completely in compliance and everything is on the up and up. That's what gives confidence to the marketplace. You can write all the rules you want, but the participant needs to know that he has a fair game.
Yeah, and we're certainly supportive of transaction reporting volumes in the dark pools. For investors such as ourselves, just understanding what the algorithms are used for matching. A lot of dark pools do not disclose that. that would be something of interest to us. So.
And then that goes to the fair and open access that I spoke about earlier.
And how would you respond again to the fact that in our securities markets, to the extent to which you have voluntary providers of liquidity through the high-speed frequency trading, as opposed to the traditional old-school specialist model?
Well, I think a lot of people today look back romantically about the old-school specialist traders, but the reality is everyone hated them. It didn't work that well. You had the flash, you had the
it was truly a two-tiered system.
It was, and people got their orders front run. There were times when the markets shut down and they didn't answer their phones. Everyone hated that market. Commissions were higher, bid-ask spreads were wider. It really didn't work that well. And, by the way, there were a lot of times when their liquidity fled. So I think that this kind of romantic notion we had of the old days is just not appropriate.
1987, right?
Right, exactly.
They all bailed.
That's
there
right.
was one platform open, and since I was the only one open that day, I get to say it. We were the only platform open in equities was the futures of the S&P 500 at CME. Everybody else closed. All the specialists hung up their phones and went away.
Well, I know that it wasn't, at least originally, our plan to open questions up, although I see a couple of folks sort of fidgeting to ask some questions. Is it possible to ask questions? Do we have a microphone? If any of you do have any questions, if you could just raise your hand quickly and we'll try to identify you. Okay, so the fidgeting just may be with references to cheetahs and the like. Okay, if I, yes.
Yeah, I've been around this business for a long time, going back to your 87 example and talking about what you're trying to do for a confidence standpoint. How do we educate the public that these things that have been created are not negative? Because people are leaving the equity markets, especially the retail investors, in droves.
Okay, lots of skepticism, and just repeating it for the purposes of the video audience, there's lots of skepticism. There are claims certainly by some of our foreign counterparts that our markets aren't nearly as robust as in the past. What do we do? What do you do to convince not only your institutional clients, but the retail folks and the general American public, not to mention to convince the regulators, that our markets are as strong and reliable as they've ever been in the past?
I think, and if I can jump in here, I think you need to be a neutral facilitator of risk management, and that's what we do. We don't participate in the marketplace. And you're absolutely right in your statement, because if you weren't right, in 2012, look what the market did. The market went and set an all-time historic high in the Dow Jones contract as far as ever. And the volumes were anemic. There was nobody in the marketplace. So you could either blame that on nobody believed the real market, or people had a lack of confidence in the market. One of those two things you could only say on that. Because you can't not set an all-time high in lieu of all the things that are going on with government policies and not have an issue with the marketplace in some way, shape, or form or another. So what we do is constantly show the tools that we have in place for participants in our market. We don't trade cash equities, and sometimes I wish we did, because I think that market needs to be changed. But you're not going to change it when people think that they are getting front-run, when they think they're getting dealt in the back room. The word dark pool, I don't care if you like them or not, the tone of it is enough to scare the hell out of you. You're like, really, I'm trading in dark pools? Is that good? It can't be good, right? So anyway, that's a problem. So there's a perception issue out there also. And I'm just a very realistic person, and that's the way it is. It's no different than when they come up with a rule at the CFTC called customer confidence or whatever. I mean, how do you go against that? But the rule is so perverse, but yet the title of it is so damaging. So, there's things like that I think that we need to message better for the public, because you are right. There's no reason why they should not be in the marketplace more today, and they're not there. They're just not there.
Terry, I 100% agree with you and the question in the audience. There is a perception problem. And I think that one of the things that the regulators in the U.S. have done very well, by and large, is not react to populism and to have a very measured and data-driven approach to enacting new regulations. Now, there's exceptions to that, and the short sale ban of September 2008 was a clear example of something that was rushed in without a lot of data and that probably damaged the markets. But I think that the U.S. markets, the U.S. regulators, are actually doing a good job of resisting political and populist pressure to put in changes, because those changes damage the markets and they also reinforce this perception that something is going wrong. And I think that internationally, I think a lot of regulators have not done as well as the US, and they're going to see the effects of that in the next few years.
And Lou, other than calling dark pools less well-lit pools, any ideas?
Price improvement pools.
Price improvement pools?
No, but I think certainly the industry has to do a better job of publishing the data so people have the facts. But we also have to remember, some of this is, we just lived through one of the worst financial crises since the Great Depression. I mean, people are a little scarred when they look at their IRAs and, they were down at one point 50% and now they're back and maybe they liquidated in the meantime. So we have to take that into account. I think the other factor is, besides time, there is a new paradigm. Computer trading is going to happen. We're going to have algorithms matching off against each other. I mean, when you see the bid ask of 1 penny and it's flickering, I mean, it's still 1 penny or 1.5 pennies, but people don't like to see that it's bouncing around. But that's probably a better outcome than when we had, 1/8 spreads. So I think, and it's only going to get worse. I mean, we saw the Twitter episode as people are reacting to social networks. There's a whole set of vendors out there right now that are, designing and marketing products to, shred apart Twitter and Facebook and try to aggregate these trading signals. Right now, trading firms, they're looking at massive amounts of technical data. Imagine what happens when they start using big data techniques to look at fundamental data. One of the brokers a few years ago was using satellite imagery to see how many cars were parked in parking lots outside of Walmart to forecast the next quarter's earnings. And so when people start integrating these forms of data, it's just going to be a different world out there.
Bart, I'll have you with our last word, other than to think twice before we head to Walmart.
Yeah, right. Well, I was just going to say in general about, and I'll take what little compliments I can get from the financial sector about we've done okay. But, we've messed up too, and so, it's a learning process. We've got all these rules that we have to do, but I want to make, because I know everybody's not concerned about, what the heck I'm with. What acronym is he with again? I'll give you a bigger picture on regulatory reform. And I think one of the reasons why we are starting to get better rules and regulations is that we've taken our time. We have tried to look at some of the data. Everybody didn't agree all the time. But what's happened is I think it's even gone overboard. Here are a couple stats. The government, 5 different financial regulators that are doing DoddFrank. DoddFrank's 2,400 and some pages. There's 1,800 sections and many other numbers. So we've got 5 regulators. They had done 31% of the DoddFrank rules in a 2-year period. By the way, most of the rules were supposed to be done in a year. So 31%. But since last July, they've only done another 6%. Our agency, which was rocking and rolling, I mean, we had done 64% of our rules and regs, but we've only done 3% since last July. I mean, it's been a long time since we rocked and rolled. Lonely, lonely, lonely time. So there's something that we need to be doing, and we haven't had one public meeting on a Dodd-Frank rule. And I think the reason is, one, we're getting lobbied. There are 10 financial service sector lobbyists for every single member of Congress. 10 for every member of Congress. 2, there's all these litigation concerns. People, they got the money, they sue us. Even if they may not win, they like the fact that it'll extend the period before they have to comply. So there's the lobbying, there's the litigation, and then to some extent there are lawmakers who haven't provided us the funds. We've had $100 million less than the administration has requested the last 2 years in a row, yet we have all of these new rules and regulations and all this data we want to look at. And the final thing is us. We've just have over-analysis paralysis. And I think this goes across the government. So it's a good thing that we've slowed down to some extent. I'm a little concerned now that we've slowed down too much. that we don't go back to what Lou said and remember why we have this legislation to begin with. It's because we went to hell in a handbasket with the economy, and the question is finding the right balance. And I appreciate that we've been able to, work with all of you all on trying to do that. I know we don't, hit it right on target all the time, but we're trying.
Well, thank you all. You've tried extraordinarily well to have a wonderful panel, and we thank you for your time. Thank you.
Thank you.
Good job, Bart.